I think what's interesting on that as well, Ian, from an Irish perspective, is even though the banks have started charging us a lot more in our kind of on our debt, they haven't passed that on to savings and deposits yet. So look, it's just as important as ever to be looking, I suppose, outside of the bank, credit union and post office when people are trying to, get inflation beating returns or even any kind of return at all.
I think that's a great point. Look, the business model of a financial institution is you pass on the higher rates on the mortgages and things like that straight away. You see it less, or it's slower on the savings side. I think one word of caution, and I know David, you and Nick and the rest of the team would discuss this with clients quite a lot, is even if you do see deposit rates tick up a little bit, just remember the higher inflation. So even if you see savings rates go from 0% to 0.5% or even 1%, you're looking at inflation a lot higher than it has been over the last decade. And that eats into what's known as your real return. So again, if you're a long-term saving and you're looking to buy something in 7 years plus, whether that's, say, a child's education, long-term house deposit, or in a pension product, you want to make sure you're getting real returns. And that's a positive return after inflation. So I think just to echo your point about continuing to look at alternatives to credit unions or post office or anything like that, I think it's very important.